Good morning and thanks for tuning in. This is Stocks to Watch on BloombergQuint and I'm Mathew. We've got three interesting stocks to talk about today, and besides that, I'll also ask my guest about his view on the government's latest production linked incentive scheme or program. That's a lot to discuss, so let's get moving. My guest is Dharmesh Kant. Good morning, Dharmesh, and thanks so much for joining me this morning. I want to start with Shree Cement on the earnings. And it seems to be a very strong number, a set of numbers that has come in. Revenues up just about 8%, net profit up 77%, and margins coming in more than 4 percentage points better than, or just about 4 percentage points better than estimated at 32.7%. So, your initial view on the numbers, and would you say that it's a good point to buy Shree Cement at this level?
Yeah, good morning, Alex. The numbers of Shree Cement were excellent set of numbers. I mean, all the cement companies have reported good set of numbers, and improvement in margins were also there. In case of Shree Cement, they have a track record of posting a good set of margins, and this time they have even topped on that. And being a cement company and such exceptional kind of a margin, over 25% on the operating level, is always phenomenal. Having said that, I mean, all the cement companies are now very expensive, and they have been expensive earlier as well. But now it seems they are, about to hit the roof soon. So as far as new bets are concerned, I think from trading perspective, one can buy it for another 10-15% kind of an upside. I mean, if you go to pre-COVID days, that kind of IC cements made around 25,000 kind of a level, that is still there on the cards to be made. And if you're an investor, you may stay glued to it till that time, and then one can take a call. For a long-term investor, it should be must. I mean, it's a must in your portfolio. It should be there. Cement as an industry has been doing very well. I think with this quarter three and quarter four has always been good for cement companies as a lot of construction activities pick up and pent-up demand is also there. So continue holding it, but I would suggest 10-15% more upside. One should start at least booking part profit.
Understood. So that takes us to the second counter, Dharmesh, and that's Power Grid Corporation. The numbers, as far as I can see, at least the headline numbers optically weren't too much to write home about. You had a 4.3% increase in revenue, which came in below estimates. You had net profit coming in 23% higher, which was ahead of estimates. But you had margins coming in at 88%, which was just about higher than estimates. So more or less in line set of numbers. But would you say that it's a stellar performance compared with some of the other performances that you've seen in the space? And would you say that you would still buy Power Grid?
Alex, I'm afraid it's difficult to say the same for Power Grid, and that has been the history of Power Grid as far as numbers are concerned. Because the basic nature of the business is such that you cannot post more than 12-15% kind of an growth on the top line, and even 15% kind of a top line growth would be very difficult on a regular, I mean, on a CAGR basis. Year on year, it's very difficult. One of year you can still get it. I mean, if you look at the stock price for last 3 years, I mean, from August 2017 onwards, this counter has languished the headline indexes significantly. I mean, it's down 10-15% from those levels to 20 to 25 kind of a level, and market is up more than 30%. I mean, Nifty itself is up more than 30% from the same period. So significant underperformer, and given the type of frenzy which is there in the market, if the market cools off, I think utility-based stocks will still get one more chance of a leg up. And from that perspective, if one is buying a power grid, then again 10-15% is there on the cards to be made. But nothing more than that. I mean, fundamentals remain weak. It's a low ROE, ROC kind of a business and heavy capital intensive. And there is no traction on the top or bottom line in a significant way. So it's a trading play. One can play it now with a buy position, and around 220 you book it out.
Understood. So that brings me to the last counter, and I have personal experience with Apollo Hospital. So I want to get your view on this company based on your judgment of how this will play out, not just for now, but for the long term, because they have quite the spread of hospitals and they have a pretty good service. The latest update is that Apollo Hospitals has bought 50% stake in Apollo Glen Eagles Hospital in Kolkata from Glen Eagles. for about 410 crore rupees, and the board has also approved raising additional funds worth 1,500 crore. So your judgment on this particular update, it's not a small amount of money, 410 crore
Right.
for the acquisition of the remaining stake in the Kolkata hospital. Your view on this deal as well as the rest of the counter?
Yeah, Alex, my only wish is that nobody needs a hospital experience. Nobody should be needing that. So that is detrimental to the business of hospitals per se. Having said that, but as the universe has been designed, one has to take services at some point in life. And those who do not, they are the luckier ones. Apollo hospitals, if you look at the balance sheet, it's I mean very skewed on the debt side compared to other counterparts. So it's almost equity is 1:1, and other borrowings, if you add up, it becomes more than 1:1, and that has been a drag on this counter. The entire sector, if you see, I mean, 10% kind of growth is not there on the top line or on the bottom line. It's a low margin kind of a business. Operating margin is 10-12%, and if you come to PAT levels, it's around only 4-5%. So if you look at the total, liability side, and the return on that is even not even 4-5%. Compared to that, this acquisition is good. Glen Eagles Hospital, I know in Calcutta, so they have a good reputation, and this will add on to their capacity itself. But being a capital intensive business with a low ROEs, low growth trajectory, and valuations are sky high. If you look at FY20, it was one of the best years of Apollo Hospital, where they posted an EPS of 32. Even if you take 10% on that, even at 35 kind of an EPS and the stock price which it is, so it's around 65 kind of a P multiple. So just because of scarcity premium, very few places are there, people are buying it, and it's operating on the top end of its valuation multiple. I mean, 10-15% can still be made, but my suggestion is to book up from this counter now. It's I mean very high priced.
Understood. And obviously, it doesn't make sense to enter fresh at this level. Which brings us
Definitely
to the
yes.
last bit of the conversation. I consider this a bit of a bonus. This was announced close to the end of market hours yesterday, Dharmesh, the government's latest production linked incentive program with a view to bringing in more manufacturers and having them set up manufacturing facilities. There is no stipulation with regard to whether or not this has to be a brownfield project or a greenfield project, and quite the spread in terms of the number of industries that are being offered this incentive. So what are the counters and companies, according to you, that are standing to benefit the most at this point?
See, given the basic guidelines which were issued yesterday, based on that, I think auto and auto component stands to gain the most. I think 1.45 lakh crores is a total package to be spent on this, and 55,000 crores will come to auto and auto component industry. And what I can make a sense of it, it's more to be driven by export-oriented schemes. I mean, all the manufacturing units which will be exporting, they would be benefiting most, whatever the guidelines they have given right now. Details are yet to come. So having that in regard, I think counters like Bajaj Auto, Motherson, Sony, Bharat Forge tends to gain the most out of it because their export is more than 50% of their top line. Whereas Hero MotoCorp, TVS Motor, Maruti, Mahindra and Mahindra, M&M, I mean, Scots, they will not benefit to that extent. So auto components will stand to gain. Battery makers, there's much has been said about batteries which are made in India, but with the electrical vehicles, the problem is lithium ion is only available in China. So how, if you are sourcing the raw material, and how this will work out will be difficult to assess as of now. What I understand is the entire battery which is coming from China, and all the electrical vehicles are having that. So that has to be seen. Other industries like food, poultry, I mean, counters like water base, or the food processing units like ITC, HUL, they all tend to benefit from the scheme. The biggest thing, Alex, to note here is whether it is a greenfield or brownfield. If it is greenfield, then it will lose its essence as of now. But if it is for brownfield with export-oriented undertaking, then the names like Bajaj Auto, Motherson, Sony, Bharat Forge stands to gain the most, and one can have a buy position. Anyways, the sector itself is looking up. With in the present scenario, when you have a vaccine also there on the horizon, and at the same time things are improving.
Let's hope your wish for Diwali actually comes true and we see a vaccine sooner rather than later. Thanks so much for joining me this morning and
Thank you
sharing
so
your
much,
views,
Alex.
Dharmesh. and have a lovely day. To you, dear viewer, we've had quite a bit discussed on this program, and of course, there's a lot more coming up in just a short while on Bloomberg Quint. You can find stories and updates in the space of business and markets on the website, so don't forget to check it out. Have a lovely day, and thanks for joining in.